Last week, the market generated a few surprising down days, causing a little bit of angst among many investors who piled into the selling routine, only to be surprised with another bounce. Buy the dip buyers plowed back into the market, even after mornings happened to be somewhat discouraging at the start. But this is a surprising market, and we're going to talk about that today. My name is Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
So the title here today is Markets Are Rigged, and they are. They're just not rigged in the way that most investors think of something being rigged. You think of something being rigged, it's politics or it's the mafia. There's not that much difference between the two.
Same group, yeah.
But we assume that means that it's rigged to the downside and we are the losers in the process. There's actually recent research from a professor of finance at Arizona State University looking at the market since 1926. And he concluded that absolutely the markets are rigged. They are rigged to the upside, but they are rigged with a very minor number of stocks. So you've been sold, if you've talked to a financial advisor or logged onto a financial website, you've been sold on the concept that broad diversification is your risk management tool and the process by which you participate in market appreciation. Well, unfortunately for you, the professor figured out that there's only 4% of the stocks that actually make the market go up. That leaves you with, let me do the math.
Yeah.
100 minus 4, that's 96% of the stocks don't do you any good. That's a rigged market.
That's an absolutely startling number, but it's a fact, and it's important to understand that if you're hearing, well, the key to your longevity in the market and your safety and your long-term growth is, wide diversification. It's just not the case. Wide diversification is a huge draw on your ability to make any headway in building permanent wealth in the market. And you really need to buy into the fact that you need to focus that down, to not buy a little bit of everything and hope something goes up, to buy what is going up and pretty much discard the rest. Walk away from it, and then the other big thing is, don't let yourself get scared out of a bull market. If things are going well, don't let yourself get talked into, well, this just can't keep going up, or it's already gone too far. There's got to be a pullback. None of that's true. The market will let you know when there's going to be a pullback. It'll start pulling back, and you need to pay attention if that becomes a very real number. But bull markets are very resilient. There are often 10 to almost 20%, can't be 20%, or they'd declare a bear market. So between those 10 and 19.9% drawdowns, those are very common in bull markets. But don't let that convince you that, well, it's over, then we're probably done here, and head for the exit. You're probably going to miss a significant amount of growth.
Well, let's talk about the 20% drawdown that turns into a definition of a bear market. First of all, these are serious bear markets, are disastrous to your financial health.
Oh, yeah.
And for anybody who's probably an ex-gen or boomer, you've got too many bear markets in your history that's created a hindsight bias. You're actually fearful that we're going to see another one when markets turn south a little bit. But
Sure.
Markets turning south 2-3%, or, well, until recently have been very normal. We actually have 133 consecutive days, and now 134, of a missing even a 3% drawdown in the market. So they are touted on social media and sometimes the financial media on mainstream network channels as the beginning of a fear-generating collapse in the market, when it's just fluctuation and noise. The bear market itself is really going to be difficult to experience going forward for a number of reasons. First of all, the amount of money coming in from 401k monies is horrendously large, and it's larger than it's ever been.
Right.
Secondly, the 2008 and 9 financial collapse, the great financial collapse, scared even the mutual fund managers, because people with instant information on their cell phone saw the market collapsing and they ran for the hills. They sold out. And even after it had recovered for a year, most of those people were still sitting on the sidelines, shaking in fear. Well, the mutual fund companies get paid by keeping you in the account, keeping you in the fund.
That's their job, right?
So without actually being a conspiracy, mutual funds figured out that when things get bad enough, they should actually become net buyers of the market to keep it from turning into an official bear and protect their own assets under management. That in itself is a huge buying pressure as stock prices fall and get down below the 15% range. We see tons of money start to kick in. Now, it actually may happen sooner than that in specific industries. If we have an industry that's
if they're especially if they're deemed important, there's a large group of thinking that says that fully functioning markets that are healthy are a national security issue. That we look at that as part of keeping America strong in the world. Is like, we need these markets to be doing well. So again, that's you're gonna have the government looking at, well, do we need to step in here? How much money does the Fed need to pour on this economy to turn that market around? Whatever that number is, that's what we're going to do. And that's what we say when we say the market is rigged to the upside. They really do fight that. They don't want to see that bear market kick in, and all the downside with that. A lot of time, the bear markets are a high bar. They go through that in the data here, and it often takes a significant crisis, serious job losses, business failures, of course, significantly lower stock prices. It's a high bar to roll a bull market over into a bear market. It's a tough thing to do. Those things all have to come together. So when you're trying to talk yourself into, well, this market's gone too far, remember, there's a lot of boxes to check before a healthy market and a healthy economy is going to roll over. It's a long list of things that have to happen together to get that market to really significantly drop.
So if you get tempted by you need to short this, basically bet on it falling. One of the things first thing you need to do is remember, markets go up 2/3 of the time. So you're betting on a 1/3 event. And you need to be a chartist where you look at the chart. If you are above the 50-day moving average and you're trying to short something, the odds are not in your favor. You're not going to win on that very often unless you're very agile, you're very experienced, and you have a large enough capital base to tolerate some move against you as the market goes up. I mean, shorting the market requires serious conviction and the ability to pay attention throughout the day to your position. So don't get caught up in the market is too high, it has to collapse from these levels. What's actually pushing the market up is concentration in technology. That's the other area that most investors miss here with regard to their portfolio allocation. And going back to what I started with was the broad diversification is supposed to be your risk management. Okay, it's risk management because it's going to keep you from being exposed to winners. You're going to own a whole bunch of losers. Well, that's not what your that's not your intention of putting capital at risk.
No.
And in this market, what we have that's never existed to the extent that exists today is a new technology. Now, we've had new technologies before. I mean, the railroads changed industry. The automobile changed industry. Automation changed industry. The personal computer changed industry. Artificial intelligence is changing industry again. This is greater than any of those other major industrial revolutions that we've had in the past. And it's not confined to what you call tech stocks.
Absolutely not. It's so broad based. It really is affecting everything, and across the board, there's going to be huge gains in productivity, huge gains in ways that no one sees coming, and that's part of why the real danger when you're thinking about a bull market, the real danger is missing it. You can't afford to miss a bull market. When everyone's making money like that, you need to be in there participating. And whether you need to set better targets, get some stop losses in place to make yourself feel better. The biggest mistake you can make is just missing it and deciding, well, this is too dangerous. I'm going to sit in cash and I'm going to just watch this go by. That's really detrimental. You're much better off to be in the market, take a little bit off the top when the market rolls over, and then bail out, than saying, well, I'm just going to miss this whole thing on the way up. That's where the real danger lies, missing a bull market. That will seriously change your ability to hit your investment goals going forward.
Well, bull markets don't come along all that often. I mean, you can have a trending market, but when you take a look at a bull market, we have to look at the bull market that happened right after World War II.
Sure.
Take a look at the one that happened after Reagan was elected and went up to the tech bubble, and then it collapsed. And then we went through a decade and a half before we really got momentum building up again. And now this bull market actually has its roots in the collapse of the great financial collapse, where we had fraudulent mortgage activity going on. Banks were on the verge of collapse, and the Fed stepped in to start being sure there was enough liquidity in the market. Right. And then the Fed got really excited about having that kind of control. At least that's my theory. And they continued to pump money in, and now they're trying to figure out how to unwind it without creating a collapse. And they've been doing so for some time. The market's still rising, and it's because of increased productivity and increased earnings, which are lifting the sentiment and the estimates for the next several years, causing excitement among investors, and they're willing to put their money on the table and say, I'll own that company because I think they own something unique and it's going to turn into a more profitable enterprise.
Correct.
October is supposed to be the month where there's a big disruption to the market. Well, we had one day that we have to classify as this month's October surprise, and the S&P was down less than 3%. And that
anytime you're going to get a lot of people telling you, well, this has gone too far, this is way too high, don't forget, the end of bull markets are usually very unpredictable. No one sees it coming, and it's going to come from a risk that is not on anyone's radar, and it's going to suddenly appear, and something's going to change significantly, and we have not seen that. And so right now, we feel like bull market's firmly in place. That doesn't mean it goes straight up. There's always pullbacks, but it's better to be in there looking for what's going up than trying to avoid this and pretending that it's already topped out, because it could be quite a while before that actually happens.
Around the world, we have central bankers who are adding liquidity to their markets, to their economies, and with very few exceptions, they are cutting interest rates and have plans to do so through next year. All of that supports a market advance. And as you just said, they're never straight up. Investors get ahead of themselves, get a little speculative, and then they say, I'm not sure I should have done that. And they kind of sit back and say, I'm going to wait for a bit before I add more money to the pot. That's a period of consolidation, and we get sideways trading ranges. They come to an end. And in the current marketplace, expanded liquidity, lower interest rates, and lower taxes are the global theme that's in place today, all of which support stocks being higher. And Perry, your comment about the U.S. market is a national security issue. Sure. It is, in this sense, that it is one of the key issues for foreign investors is that we operate with a strict set of laws when it comes to our capital markets. We have a high degree of liquidity, and our legal system protects investors. It is unique in the world, which is why money comes here and
Yep.
we must maintain that integrity in order to maintain our financial position in the world economy. And currently, government is committed to doing just that. Do not be discouraged. You got a bad trade or two, deal with it. Forget about what you've learned in the past that's affecting your emotions. Do a critical analysis of your position. And if it's really bothering you and keeping you awake, it's probably time to sell it and take a look for something else that you'll be comfortable with. If you have questions about your portfolio, whether or not you've got proper sector exposure, you can give us a call. We'd be glad to chat with you. It doesn't cost you anything. If you haven't subscribed to our podcast, do so. There's a button on the screen to subscribe. If you like what you heard, pass this on to your friends, family, and coworkers. We appreciate that. Stay tuned because we have more to record and we will be back. Have a great day.